Hello fellow intelligent investors, my name is René Salman, and in this video I would like to talk about a topic every investor is worried about: losing money. In fact, I believe that beginner investors in particular are prone to losing money when they are starting to invest if they aren't careful and if they haven't spent a decent amount of time on educating themselves. So in this video I would like to share 3 common ways investors lose money and how to avoid them. So let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Salman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, let's start right away with the first way to lose money when investing in the stock market. I think the most reliable way to lose your capital in the stock market is to be lazy and not do your due diligence. As an investor, you need to realize that stocks represent an actual ownership stake in a company. A powerful mental model that Buffett keeps repeating in his interviews and his shareholder letters is that we should adopt the mindset of a business owner. Simply pretend that you are not just buying a tiny fraction of a business, but instead buy the entire company. As Buffett puts it, buy a business, don't rent stocks. An investor should ordinarily hold a small piece of an outstanding business with the same tenacity than an owner would exhibit if he owned all of that business. Let's say you would invest $1 billion and plan to buy a whole business. What would you do before signing the final contract for the purchase of that business? Of course, you would spend a ton of time researching how strong and competitively advantaged the business is. Does the company possess a strong and durable moat? Has the moat been impaired in the recent past? Did the company grow in the past? How fast did it grow? How big is the total addressable market? How big is the market share of the company right now? Can the company grow its market share over time? How profitable is the business? What do return on invested capital and return on equity look like? What do the firm's margins look like? And do you expect the company to be able to increase its margins over time? Is a competent management team running the business? Are their interests aligned with your interests as the owner of that business? Is the management team trying to deepen and widen the moat? How much debt does the company have? I think this set of questions should give you an idea of what you need to look at before you actually buy stocks. And clearly there are a lot of other aspects that I didn't mention yet that you would also want to examine further before signing the purchase agreement. So let's say you would not invest $1 billion, but only let's say $10,000. Why would investing $10,000 be any different? Well, I think investors who skip these critical steps, who treat stocks like random digital tickers that are up on some days and down on others, who simply buy stocks because they have a gut feeling that their investment will turn out to be a winner. Well, I believe they are destined to lose in the long run. I would argue that these guys aren't actually investing, they are speculating. Because the true investors, they analyze the business, and most importantly, they value the business properly. Just because a popular technology company is trading for $50 per share does not make it worth $50 per share, because popularity is not the same as underlying value. Okay, a second common way to lose money in the stock market is to be impatient and short-term oriented. It is rumored that one day Jeff Bezos, the founder of Amazon, asked Warren Buffett in person why the average Joe cannot replicate his success. Warren, your investment thesis is so simple and yet so brilliant. Why doesn't everyone just copy you? And Warren Buffett apparently replied, because nobody wants to get rich slow. Albert Einstein already said that compound interest is the 8th world wonder of the world. He who understands it earns it. He who doesn't pays it. And let me illustrate the power of compound interest with a simple example here. Let's say you are able to invest $1,000 regularly, let's say each month, and you are able to achieve a rate of return of 10%. How long do you think it will take you to crack the $100,000 mark? Well, we can simply use a compound interest calculator here and figure out that it would take you roughly 6 years. Strictly speaking, a little longer, but $98,000 is close enough for the sake of this example. If you continue to invest $1,000 regularly, it will take you only 4 years to crack the $200,000 mark, then 3 years to earn your third $100,000, and then only 2 years to reach the 400K milestone. Charlie Munger, Warren Buffett's longtime business partner, has already said that accumulating the first $100,000 is the most difficult part of building wealth. Getting wealthy, he explains, is like rolling a snowball. It helps to start on the top of a long hill, to start early and to try to roll that snowball for a very long time. But have you noticed how impatient people are these days? How unrealistic they are when it comes to sustainable long-term returns? I think after the wild 2020 stock market ride, people expect returns of 40 to 50% or even more to be normal. But over the long run, your returns will reflect the growth of earnings power of the companies you own. And therefore, these kinds of returns north of 50% are not sustainable for almost everyone. That's why it's important to adjust your expectations, to focus on the downside risk of your investments first, and to give your investments time to grow and compound. I think especially in my generation, more and more people are interested in the stock market actually. They want to make a lot of money from stocks. But I rarely meet people who have the patience to spend time and effort to first educate themselves on the art of investing before they actually put their money into stocks. Instead, they start by painting a rosy financial future. It almost seems like nowadays we are trained to be impatient, I would say, because we are surrounded by so many instant offerings, and therefore everyone wants that instant gratification. But in the world of investing, if you don't have a long-term focus and don't understand that building wealth simply takes time, you are actually at risk of never achieving your financial goals. If you are impatient, you are more likely to put your money into very risky investments that might turn out to be a 10-bagger, but where there is a very high probability of losing everything. You are more likely to buy a stock when you are impatient, even though the stock might not be available at an attractive price that is offering you a margin of safety. And you are more likely to sell a stock after a short period of underperformance. I think you will most likely end up trading in and out of positions, and too much activity will simply kill your returns. I came across the following analogy by 10K Diver, who's a famous Twitter user, and I just love it. He said, your portfolio is like a bar of soap. The more you handle it, the smaller it gets. So be patient, be passive, don't trade in and out of positions, and understand that what happens in the short term in the stock market is completely out of your control. One of my other favorite Twitter users, he's called Mostly Borrowed Ideas. He also shared a great thread quite recently, in which he described the observation that many folks just want to get rich quick. And this is probably why get rich quick schemes are all over the place right now. You've certainly encountered ads of crypto or forex traders on social media. And similarly, if you join investing-related Facebook groups, you will quickly notice that people are primarily looking for a quick way to make money. They are asking for stock tips, but they aren't actually willing to do the work required to achieve above average performance. Let me share the following cartoon with you here in this context that describes exactly that phenomenon. And to get back to Mostly Borrowed Ideas' point. Well, he said that we as individual investors are capital allocators too, just like a company's manager. And if you continuously make short-term oriented and bad capital allocation decisions, you will eventually lose money. And the people who have a longer-term view and make better capital allocation decisions, they will be rewarded. And that is probably why it is estimated that 70% of wealthy families will lose their wealth by the second generation and 90% will lose it by the third. So what's the bottom line here? As an investor, you need to be patient. In fact, I believe that being patient is the biggest virtue you can have as an investor, because doing nothing for a long period of time is incredibly hard. There are so many cognitive biases that will want you to take action. And the following quote by Andrei Kostolany is one of my favorite quotes of all time, and it summarizes that issue, or the issue at hand that I just described, quite nicely. He said, "I can't tell you how to get rich quickly. I can only tell you how to get poor quickly by trying to get rich quickly." Another common way to lose money in the stock market is to buy high and sell low, making buying or selling decisions based on your emotions, buying when you are excited and selling when you are scared. But you may ask, why would anyone buy high and sell low? I mean, even a fourth grader will probably understand that this is a losing strategy. And clearly no one puts their hard-earned cash into a stock or the market in general with the intention of following this formula for disaster. But a surprisingly large number of people is doing it anyway. Well, the explanation for this phenomenon is quite simply. Fear and greed are the two most powerful human emotions, or two of the most powerful human emotions, and they drive short-term crowd psychology and thus stock prices. In fact, I believe that even professional investors are still subject to these emotions, to greed, fear, and also peer pressure. At the end of the day, these emotions are simply hardwired into all of us, and it's important to acknowledge this. So let's maybe discuss these two emotions separately. Essentially, greed represents the willingness to take on more risk, and often too much risk. The main problem here is that most people want to get rich quickly as possible. I think we addressed that already. And bull markets invite investors to try their luck because seemingly everyone seems to achieve impressive returns and no one seems to be losing. The internet boom of the late 1990s and what we are witnessing in stocks like GameStop today or in some meme stocks are a perfect example of this herd behavior. How can you not join the party? Back in the late 90s, people were greedily chasing after price gains that have already happened in the past, and they were pretty much ignoring the true worth of these assets. And as I said, in certain pockets of the markets, we are witnessing the same herd behavior at the moment as well. But this get-rich-quick thinking makes it hard to maintain a disciplined, a rational, and a long-term investment approach. But especially in times when euphoria is through the roof, it's crucial to stick to the fundamentals of investing, to stick to the investment process you have maybe developed during calmer times, to maintain a long-term focus and to ignore your neighbor who's speculating in certain stocks and maybe for a brief period of time enjoying insane returns or gains. An example of Warren Buffett's long-term strategy, an ability to ignore the herd, is again the dot-com bubble. Buffett stuck with his time-tested approach of only buying undervalued securities, and he didn't buy into the hype. He didn't buy the internet stocks just because they had .com in their name. He stuck to companies he understood and companies that appeared to be underpriced by his market. And I think his long-term performance proves him right. In fact, one noteworthy Barron's cover story was titled "What's Wrong, Warren?" and was published in 1999. In December 1999 more specifically. And the article was clearly questioning Buffett's stock picking skills. And this was just a few months before the dot-com crash provided a clear answer to the question raised by the authors of this article. So in many cases, it often becomes clear in hindsight that a large portion of a stock's gains was driven by investors who were relying heavily on momentum as a factor. But the gain in the share price was not supported by the fundamentals of that business. And over the long term, a business's underlying earnings power is what drives stock prices. And so short-term gains that were not backed by an improvement of the underlying business will eventually morph into long-term pain. But this is only one side of the behavioral coin. Just as market participants can become overwhelmed with greed, they can also succumb to fear, especially when stocks suffer large losses for a sustained period, say losses of 10, 20 or 30%. Investors can collectively become fearful of further losses, and so the mass selling starts. You too will probably feel this urge to do something when the market crashes, to minimize your losses, or to raise cash to buy stocks at bargain prices if the price decline continues. And these feelings can indeed become overpowering for many investors. But in my view, this mass exodus from stocks shows a complete disregard for the business owner mindset that I discussed previously, and a long-term investing strategy based on the fundamentals of the business. Sure, losing a large portion of your equity portfolio can be a tough pill to swallow, but you have to acknowledge that no one can consistently time a market bottom, and investors who are trying to trade in and out of their positions will ultimately miss out on the inevitable recovery. Moreover, investors have to acknowledge that a decline in share price is just a temporary paper loss if the business itself or the fundamentals of the business are fundamentally intact. So I guess the bottom line here is that greed and fear represent the two sides of behavioral investment risk not a lot of people talk about. I think it is fair to say that they are the two most powerful emotions involved in investing. And succumbing to these emotions can truly hurt your returns. Try to avoid getting swept up in the dominant market sentiment of the day, which can be driven by irrational fear and greed, and stick to a fundamental business analysis. I think it also helps to choose a suitable asset allocation and, maybe more importantly, an appropriate level of diversification. If you are extremely risk averse and cannot stomach large drops in a portfolio's value, you are more likely to be influenced by fear, and therefore you need to adjust or build your portfolio accordingly. When investors find themselves outside of their comfort zone, I think they become vulnerable to the powerful emotions that I just outlined, and this can lead to costly mistakes. And Warren Buffett agrees with that, and he once said, "Unless you can watch your stock holding decline by 50% without becoming panic-stricken, you should not be in the stock market." And that should already be it for today. As always, may your finances and investments prosper. Good luck.